Welcome subscribers to the Saturday Summary for July 26th of 2014. As always, your weekly summary of market and economic news for annuity and life insurance professionals. I'm Jonathan Illig of Brokers Alliance, here for the biz. Well, the broad indices this week finished this last full week of July mixed, with the S&P 500 squeaking out a weekly gain of 0.1%, the Dow losing 0.82%, the NASDAQ gaining 0.4%, and the Russell 2000 posting a weekly loss of 0.60%. Now, Friday saw the biggest action, with both the S&P 500 and the NASDAQ losing half a point, and the Russell 2000 index losing a full point on Friday. Now, this brings the Russell 2000 small cap index to a year-to-date loss of 1.63%, while the Dow is positive year-to-date by 2.32%. Now, of course, the bulls are focused upon the S&P 500 index, which with a positive year-to-date gain of just over 7%, and the NASDAQ index close behind that. Meanwhile, the yield on the benchmark 10-year Treasury Note continues to languish, closing the week almost 4% lower than at this point last year and 18% lower since the start of 2014. So, if the markets were basically flat for the week, why is the headline this week, "Junk Dumping Accelerates"? Well, this has to do with the outflows from high-yield bonds. This is one of three major things we need to address in this week's summary. The other two are the narrowing of the performance spread between small-cap stocks and large-cap stocks, which combined with the outflows from high-yield bonds is an early warning signal of the end of a bull market. And the third, the SEC adoption of some new rules regarding money market funds this week. Now, in Friday's financial press, there were numerous reports and warnings about money flowing out of high-yield bonds. For the second consecutive week, large investors were getting out of high-yield bonds, also commonly called junk bonds. Now, a report from Bank of America Merrill Lynch on Friday showed $4.8 billion was dumped from these global funds in the week ending Wednesday, July 23rd. This is the most seen since July of 2013. Guggenheim also published a warning on this. Why should you care? Well, the high-yield bond market has been playing a central role in the rise of the equity markets. This is the marketplace that lends money that corporations have used to fund their record stock repurchases, which of course is one of the three major drivers that have pushed stock prices higher. We've talked a lot about this in the summary. Now, as stated in one of the articles on Friday, this financial engineering, for even the worst of the worst credit, has been enabled by massive inflows into high-yield and leveraged loan funds, lowering funding costs and allowing CFOs to destroy or re-leverage their firms, all in the goal of raising share prices. Simply put, equity prices cannot rally for long without the support of high-yield credit markets. Never have, never will, end quote. Well, the issue this week with small-cap stocks is a technical indicator that tracks their performance versus large-cap stock. Now, in a nutshell, historically, small-cap stocks, such as represented on the Russell 2000 index and also a large part of the NASDAQ index, typically outperform large company stocks. This is just because they have more potential. Now, in an article by Michael Gayed on Friday titled "Unbelievable Collapse in Small-Cap Stocks," that's on page 5 of the written summary, the author states that small company stocks, quote, "can be seen as a good indicator of risk sentiment beneath the surface." Now, Mr. Gayed continues with the small-cap Russell 2000 index meaningfully underperformed the S&P 500 this year in a shocking way, causing them to give back all of their 2013 outperformance and sending its price ratio relative to large cap stocks all the way down to 2011 levels. Now, in comparing the performance of the Russell 2000 index to that of the S&P 500, Mr. Gayed further states, "A falling ratio means underperformance. That is utterly brutal and came out of nowhere. This implies two things," he says, which are important to keep in mind. First, we remain in an unprecedented environment. And secondly, if most of that money is hiding out in the S&P 500, then we are seeing a narrowing of attention by traders. And it is often said that the narrower a rally gets, the closer it is to nearing its end. While this will only be known in hindsight, it is worth noting that the staircase up, elevator down dynamics haven't disappeared, end quote from Mr. Gayed. Thus, subscribers, with the outflows from junk bonds and the collapse in small company stock performance, our headline, "Junk Dumping Accelerates." Now, of course, these are just warning signs, not clear signals of when the markets have actually reached the top or when the expected correction, or worse, may occur. Now, as the article on page 9 states, there will be no warning before the next crisis hits. Now, on that note, here's an interesting chart showing that the longer the time between market corrections that follow a recession, the deeper that decline. We are now over 1,000 days since that last correction. Now, the third major item this week is that the SEC adopted new rules for money market funds. Now, we've been talking about in the last two summaries, while many retail investors think that these money market funds are essentially cash, as we've learned, they are not. They are investments in the short-term repo lending markets between the big institutional traders. And again, that market's over $1.7 trillion daily. Well, this week the SEC adopted new rules for these type of mutual funds, but only for those sold to institutional investors, not those sold to individuals, at least for now. And they are big changes. First change is the share price will be allowed to fall below $1. Now, traditionally, money market mutual funds were maintained at what we call a $1 par or $1 par share value. This is one of the reasons that many people confuse these funds with cash. Well, when the new rules become effective, this will no longer be the case. A share value will be allowed to fall below $1. Now, the second major rule change is that fund managers will now be able to impose withdrawal limits or stoppages in a crisis. Now, the intent of this new rule is to try and prevent a bank run, as was seen in the money market funds during the 2008 financial crisis. Now, this caused STA Wealth Management's Lance Robert, a prolific financial writer, to pose the following rhetorical question. What does the SEC know that we don't? Well, at page 7, you can read a great piece about these new rules in the article titled, After SEC Rules, My Advice, Stay Out of Money Market Funds. Well, in thinking about all this increasing risk, heck, we haven't even mentioned the Mideast and the Ukraine situations. I recall some important other numbers I was looking at this week. The amount of lifetime guaranteed income available with guaranteed lifetime income benefits on deferred annuity contracts. Check it out for a 65-year-old. I think these numbers speak for themselves. Well, that's your Saturday summary for Saturday, July 26th of 2014. This is it for July. Have a great weekend. We'll see you next Saturday.